What's going on, guys? It's your boy E is Profitable. This video is about imbalances in the market. There's a famous quote that says, everything in life has to have balance. There is so much truth to that, and that applies to so many different fields. That is no different with trading. So this video will be going over what are imbalances, why imbalances happen, and how do we identify imbalances in the charts. This is a beginner's version of imbalances. Later on, we'll be touching on more intermediate and advanced topics. So let's get straight to it. Yeah. These videos are meant for educational purposes only. Any trades taken in the financial markets are under your own discretion. The information taught should be demoed and only taken to live accounts under your own responsibility. E is Profitable will not be held liable for anything you do with the information presented. All right, guys. So what are imbalances? An imbalance is a displacement in price action created by an influx of too many one-sided orders. In other words, imbalances are gaps, whether they're small or big, they're gaps left behind in price action due to price impulsively moving towards one direction. So there's a few words here that I want to touch on. So when I say that imbalances are gaps left behind in price action due to price impulsively moving, I want you to think, what causes price to move impulsively in one direction, right? So there's many different scenarios that can cause that. For example, let's say news. If there is war happening, right? The markets can impulsively move in one direction. How does that happen? Well, let's say, it is announced that the US is going to war with China, for example. Well, there could be a massive sell-off in the market. And by numerous people selling, more than those that are on the buying side, that can push the price down exponentially, leaving gaps in the market. And the interesting thing with the market is that the market is always balanced, or it should be balanced, right? So whenever you see areas of imbalances, there is a high probability that the algorithm, right, that the market makers are going to move price back to that direction. Now, there are a lot of footprints that are left behind when these moves take place. And if you incorporate imbalances in your trading, it'll most definitely increase your accuracy. So again, you're looking for areas in price action where gaps are left behind, and I'll be identifying those for you. And then always keep in mind that when those type of moves occur, there's high probability that price is going to find its way back to those areas to close out the gap. Why? Because the market, for the most part, has to be balanced, right? That is the way the market functions. As I always state to my students, there are only a few reasons why the market moves. One, for liquidity, right? It's looking for money. Where does money sit, whether it's in the buy side or the sell side? And two, to rebalance, right? Whenever it makes an impulsive move one way, it will find its way back there for the most part to rebalance itself. All right. So now that we have, that we've went over the definition and we have that concept understood, let's go into the charts. All right, guys, so let's go straight to the drawing board and then we'll look at some charts. So let me draw what balanced price action looks like, and then what imbalanced price action looks like, and then we'll go from there. All right, so let's imagine that these are three bearish candles. So what is balanced price action? So let's say this is the wick for this one here, and this wick stops there. Let's imagine that the middle candle does not have any wicks, and the one at the bottom has a wick right there. And then we have another wick here. So this represents balanced price action. Okay, balanced. Why is it balanced? It's balanced because there are no gaps in price, right? We know that the bottom. So let me highlight this for you. We know that on this candle, right, that bottom wick tapped right into this candle's upper wick, right? And it left no gaps in price. Well, that's what you should be seeing all the time in the marketplace, right? That is a balance. That is balanced price action. Now let's compare to what imbalanced price action look like, right? So we have the same scenario. We have 3 bearish candles. Doesn't matter what the size is. All right. And imbalanced price action will look something like this. So let's say this was a smaller wick. Let's say on this candle, it was also a smaller wick. All right. This is imbalance price action because there is a gap, as you can see, there is a gap from the bottom of this candlestick to the bottom of this candlestick. There is a gap. Well, that gap is what we call an imbalance. You see how on the left side, there is no gap. Everything is balanced. You know, everything has been mitigated. On the right side, everything has not been mitigated. There is an area that was left behind due to an impulsive move in price action, right? And so this is imbalanced. Well, why does this happen? Well, the reason why this happens is oftentimes because the market makers are pushing price to one side, you know, a lot more than on the buy side. So let's say the market is moving, right? Let's look at this scenario. Let's say the market is moving down. And then with this candle, there was so much selling pressure and then so much selling pressure on this third candle that the price keeps moving down that it never mitigated this area. So it left this area behind. So typically when you see a scenario like that, let's make this one longer. When you see a scenario like that, it is highly probable that the market makers or the algorithm, right, is going to have to come back up here, right? And let's make these green candles. It's going to have to find its way back through price action to close out that gap, right? We can say it does this. And let's imagine that this one here is a red candle, right? But it has a long wick, right? So when the market does this, what that means is that it closed the gap, right? So now the market is rebalanced, right? So that gap has been closed. See how that gap has been closed? That gap would no longer exist. That means that the market has been balanced. Okay. So how do you use this to your advantage? Well, if you can identify imbalances in your charts through price action, you can look for setups. For example, in this scenario, I could look for a setup to buy because I know that the market is showing me that it wants to go back up, right, to close that imbalance, right? So then I could look for some long positions, let's say from this area up to that imbalance, right? Because I know that price action is going to make its way up to close that imbalance. Or another way to participate in this market is you can then look for sales from the imbalance, right? Let's say you can look for sales from the imbalance, all right? And let's say you believe that the market is going to continue coming down. So then what you could do, let me change this color real quick just to make it a little more noticeable for you guys and make this darker. All right, so what you could do is you say, okay, I see that the market is showing that it wants to go back up to close that imbalance. So then you can get into a sell position here and then continue to ride the market lower, right? So that's another way to participate in the market when you see these imbalances. So it's very important that you identify them, right? You know how to identify them, um, that you know how to identify the ones that are more probable for the market to come back and close. And we'll be discussing that in other videos. It's also important for you to figure out ways that you can participate in the market when imbalances are created, whether it is as a buyer because you're riding your way back up to those imbalances, or as a seller when price touches and close those imbalances, or taps into those imbalances, and you believe that the market is going to continue to the sell side, then you can become a seller. All right, so let's just take a look at the chart, and then we shall look for some imbalances. All right, let me, okay. All right, so let's look at some charts. Let's look at if we can identify where are there imbalances, right? So very quickly, you can see the bottom of this wick to the bottom of that created an imbalance, right? So we know that that's an imbalance. Now we do see that on this particular whip here, it did come up and tap it, all right, and then it continued. But typically, when it's a small tap like that, I don't consider that a close of an imbalance. You know, most likely price will find its way back up there to close it completely. And you see right here, when we move to the right, price action did end up closing that imbalance, right? So let's go to a smaller time frames and see what we find. All right, so let's use this as an example. This is a very good example right here. So you can tell here that price, right, was bearish. It made an impulse up. It retraced a little bit, and then it made a huge impulse up, right? So that is buying pressure. When that buying pressure occurred, you can see where it left behind an imbalance, right? And again, because the market has to be balanced for the most part, what did price do? Price found its way back into that imbalance area, and then it continued to go up, right? So that's why I said that there are multiple ways that you can become a participant in the market when you identify imbalances. So if you were bullish and you had a bullish bias, then this could have been a great opportunity for you to wait for price to tap into that imbalance, and then you could have got into some buys and rode that wave back up to whatever point of interest you had, right? So this is, again, a very basic explanation specifically for beginners as to what imbalances are and how to identify them. This topic is more complex, and there are other areas that we will be discussing later. So I just wanted to briefly go over that with you. Take the time to go through your charts and look for these imbalances, and document what did price do when those imbalances were tapped into, right? We have another imbalance that was created here. You see the impulsive sell move down. What did price do? It came back, it closed that gap, and then it continued further down. So again, you could have been a seller from this area, and you could have wrote this down. That could have been an easy 1 to 5, 1 to 6, depending on how you got in. All right, so as a homework, go through your charts, imbalances occur in various different time frames. So it doesn't matter if it's daily, weekly, 4 hours, 2 hours, 15 minutes, 5 minutes. It happens everywhere. Highlight the imbalances and then look to see what did price do after the imbalance was created. And did the price come back to those areas to close those imbalances, or did it tap into those imbalances? And if not, what did it do next? All right, guys. So I hope that this video was insightful. Again, subscribe, hit the notifications. We will be going into very deep topics and in-depth topics for intermediate and advanced traders. All right. So hope you guys have a great weekend. I'll talk to you guys soon.